If you're an ordinary investor trying to build long-term wealth, you've probably heard people say, just invest in the S&P 500. But then you log into your brokerage account and see VO, IVV, SPY, FXAX, FNILX, SPLG, and suddenly it feels confusing. In this video, I'm going to break this down step by step. First, I'll explain the difference between ETFs and mutual funds. Then we'll go through the most popular S&P 500 funds and how to choose the one that fits you best. Let's start with the basics. What's the difference between an ETF and a mutual fund? An ETF, short for exchange-traded fund, trades on the stock exchange just like a stock. That means you can buy and sell it during the day. The price moves throughout the day. You usually need to buy whole shares, unless your broker allows fractional shares. ETFs are generally very tax efficient. A mutual fund, on the other hand, only trades once per day after the market closes. You buy in exact dollar amounts, like $100 exactly. It's extremely convenient for automatic investing. It's often the default choice inside 401(k), and IRAs. So, here's the simple way to think about it. If you like automation and set it and forget it, mutual funds are usually easier. If you like flexibility and intraday trading, ETFs are more flexible. Now that we understand that, let's talk about who runs most of the popular S&P 500 funds. The space is dominated by the big three asset managers: Vanguard, BlackRock, which runs iShares, State Street Global Advisors, which runs SPDR funds. These companies manage trillions of dollars and offer extremely low-cost S&P 500 funds. And here's the key point. They all track the same index. Over the long run, performance differences are tiny, usually 0.01% to 0.05%, mainly due to tracking error and dividend timing. So this is not about finding a better S&P 500. It's about finding the one that fits your situation. Let's start with ETFs. The largest S&P 500 ETF in the world is Vanguard S&P 500 ETF, ticker VOO. It has over $1.5 trillion in assets and charges just 0.03%. It's widely considered the gold standard for long-term investors. Next is iShares Core S&P 500 ETF, ticker IVV. It also charges 0.03% and is known for slightly efficient dividend reinvestment. Then we have the original ETF, SPDR S&P 500 ETF Trust, ticker SPY. It launched in 1993 and is the most heavily traded ETF in the world. Its expense ratio is higher at 0.0945%, but it has unmatched liquidity. If you trade frequently or use options, SPY is usually the best choice. And for investors who want the lowest cost ETF possible, there's SPDR Portfolio S&P 500 ETF, ticker SPLG. It charges just 0.02%, making it extremely attractive for long-term holders. Now, let's move to mutual funds. One of the most popular is Fidelity 500 Index Fund, FXAX. It charges only 0.015% and has no minimum investment. It's one of the cheapest official S&P 500 mutual funds available. Then there's Vanguard 500 Index Fund Admiral Shares, VFIX. It requires a $3,000 minimum and charges 0.04%. It's ideal for automatic investing at Vanguard. For Schwab users, there's Schwab S&P 500 Index Fund, SWPPX. It charges 0.02% and has no minimum. Now let's talk about the interesting outlier, Fidelity Zero Large Cap Index Fund, FNILX. This fund charges 0%, zero fees. But it doesn't officially track the S&P 500. Instead, it tracks Fidelity's own large-cap index to avoid licensing fees. In practice, its holdings are nearly identical and performance correlation is almost 100%. However, there are two trade-offs. First, portability. FNILX is proprietary to Fidelity. You can't transfer it to another brokerage without selling it. Second, dividend timing may vary slightly compared to official S&P 500 funds. Now here's a simple summary in practical terms. FNILX, 0%, $0 minimum, best if you're staying with Fidelity long-term. FXAX, 0.015%, $0 minimum. Lowest cost official S&P 500 mutual fund. SPLG, 0.02%, lowest cost ETF. VLO, 0.03%, largest and most established ETF. IVV, 0.03%, tax-efficient ETF. SWPPX, 0.02%, best for Schwab investors. VFIX, 0.04%, ideal for Vanguard automatic investing. SPY, 0.0945%, best for trading and options. So how do you decide? Here's my personal rule of thumb. If you invest through a 401k or want automatic investing, go with a mutual fund like FXAX, SWPPX, or VFIX. If you prefer ETFs and want lowest cost, SPLG or VO are excellent. If you trade actively,
SPY.
If you're fully committed to Fidelity and want zero fees, FNOX. Now, let's talk about why fees matter. If you invest $100,000 at 7% annually for 30 years, at 0% fee, you end up with about $761,225. At 0.09% fee, you end up with about $741,407. That's almost a $20,000 difference, just from expense ratio. Same market, same index. Only difference is cost. So, here's my final advice. Don't overthink tiny differences in tracking. Don't chase headlines. Pick a low-cost fund that matches your brokerage and investing style. Automate your investments. Stay consistent. The biggest advantage you have is time and discipline. If this video helped clarify things, please consider liking and subscribing. It really helps the channel and allows me to continue creating content for ordinary investors like you. Thank you so much for watching, and I'll see you in the next video.